on a monetary system that promotes eudaimonia, which means a life of fulfillment, and not financial bubbles. I gave this presentation at a congress on positive psychology in the US. Now, my argument is as follows. The way that money is organized in society today supports mindless consumerism and hedonia, the pleasant life for the privileged few. But we can create a better monetary system that supports eudaimonia, a life of fulfillment, if we do two things. One is to direct the flow of credit away from financial speculation and towards production that is sustainable. And the other thing we need to do is to ensure that the power to create money is taken away from private banks and placed under public control. That's my argument in this presentation. Now, let's look at what we know about money. Well, as regards money and the individual, there is some research on that. One is that the mere presence of money, a screensaver like this blue one, reduces generosity in the research subject. Another thing we know is that wealth fosters extrinsic motivation, not intrinsic motivation, not autonomy in people. Now, about money and society, well, we have a whole discipline called economics, but it's curiously silent on money and especially where money comes from. This is something that non-economists don't really know. But a simple fact like this one here, that the money supply, all the money extant in the US, well, 100 years ago it was $15 billion, and today it's about $1.7 trillion. So that's a 100-fold increase in the money supply. A meal that cost you $1 in a fancy restaurant 100 years ago today costs $100. Where did all that extra money come from? Where does money come from? Well, let's look at a nation's money supply at first. That's the entirety of the money in a country. Well, it consists of two things. One is cash, and that means notes and coins, and that's about 5%. And that is created by the central bank, the Fed in the US. So nothing strange about that. But the other part of the nation's money supply, well, that's money in the bank. That's account money, the deposits in everyone's current accounts and summed over the entire population. Take everybody's bank accounts, add those numbers together, add the cash, and you have a nation's entire money supply. Where does this bank money, the account money, where does that ultimately come from? Well, banks create it when they do what we call lending. When they lend to borrowers, they create money in that process. The bank does not transfer money from some other account to yours when you borrow money in the bank. This is what everybody thinks, but that's not the case. Let's look at it in detail. Money is created by banks when they lend. Go to the bank and take a loan for $300,000. These digits are merely typed into your account by the bank officer. This is money ready for you to use. This amount adds to the national money supply, money creation. Money is being created in the process of borrowing from a bank. At the same time, the bank opens a loan account in your name, and this account records your debt minus $300,000. Now the bank's books balance $300,000 in your account and minus $300,000 in your loan account. Everything is hunky-dory. The bank has extended its balance. It has created money out of thin air. When you repay the loan, what you do is you transfer money from your account to your loan account. You take out money from your regular account and put it into your loan account. And that process reduces the nation's money supply because money disappears from your current account. And we can call that money is destroyed or money is retired from the money supply. So altogether, banks create money when they extend loans to you, and when you repay the loan, money is destroyed again. This is simply how money functions in a modern economy. If you think that sounds strange, check out this article from the Bank of England. It's called Money Creation in the Modern Economy. And as you can see here, this article explains how the majority of money in the modern economy is created by commercial banks making loans. Here are some more quotes from bankers and economists that you can read. So, money creation by banks, that entails three problems, actually many problems. I mentioned three of them here. One is the fact that this creates bubbles. In good times, banks lend like crazy. This is how they earn their money from the interest on loans. That feeds bubbles, financial bubbles, like the years before 2008 when home loans went bad and that eventually busted Lehman Brothers. It went up in smoke, and we have the whole 9 yards after a financial crisis with bank bailouts, homelessness, unemployment, a lost decade, if not in the US, then certainly in Europe, and in particularly in the Mediterranean countries, where you have 50% of young people being unemployed, maybe for 10 years, no end in sight. It also creates a debt burden. Consider this example. You take out a 30-year fixed rate mortgage on your house for $300,000 at 4%. That means over the 30 years you'll repay $500,000. So money that was created by a bank officer by a few keystrokes will end up costing you the interest of $200,000, which equals something like 5 years' work. Consider taking a job cleaning at the bank for 5 years for nothing. That's what interest amounts to. A third problem is inequality. It's a fact curiously absent in Piketty's book. He doesn't mention money creation by banks. But boom-bust cycles concentrate wealth because rich insiders, they always know how to sell assets before the bubble bursts, and it's ordinary folks who lose out. There is essentially no trickle down in this kind of economy. There's a giant sucking up from the 99% to the 1%. We also need to know that banks create money as they see fit. We can ask, do banks create money in a socially responsible way? Well, we've never heard of that, and they actually don't. Their only concern is, can this loan applicant repay the loan? That's why banks like collateral, like a home or stocks, because they can sell the collateral if the loan goes bad. If the borrower cannot repay the loan, they can sell that. And that's why today some 80% of bank lending is for property, stocks, corporate mergers, etc. All existing assets that inflate, that increase in price, and thus create bubbles. Only about 20% of bank lending is for investment in new businesses. That's paradoxical. We all think banks lend to invest. They rarely do anymore. There's a point here that's very important, and that is that where new money and credit goes, businesses flourish, work is paid and gets done, initiatives thrive. Without such investment, things flounder. Look around in society. People can certainly do things in their spare time, but if you really need things to happen, you need to put people to work on it full time, and for that you need credit, you need to borrow from a bank. What we need to do now is to have banks spend new money for the proper purposes. And we can ask, should they be free to create the nation's money supply and decide where that money is spent? Well, that depends. We can distinguish credit for three purposes, and this is something that Richard Werner, a professor of economics at Southampton University in the UK, has described. He says, well, there is credit extended for financial speculation. That's when you purchase stocks and real estate. That drives up prices and creates bubbles, as we've seen. Think Wall Street bonuses, think champagne, cocaine, and strippers in our terms here from the beginning. That is wildly hedonic. That is the life of pleasure that money affords, too much money. The second kind of credit that is often extended is for consumption, and that is inflationary if it's not followed by new investment in productive capacity, and we may call that mildly hedonic borrowing for increasing personal consumption. The third kind of credit is for productive investment. New goods and services create a revenue stream by which you can service the loan. That takes us into the real economy, not the financial economy, like in bullet point number 1. Now, if this production is exploitative, well, then it's not productive. And from that it follows that production must be ecologically sustainable. We cannot deplete the earth's resources and lay it waste. Production must be ecologically sustainable. In that way, eudaimonia can be supported. We need financial authorities to provide credit guidance and ensuring that banks' new money goes to businesses engaged in sustainable production. We cannot have banks do whatever they like. That's why we have a highway code. Driving on the right side and on the left side of the road is socially dysfunctional. We need to look at what banks do in the same manner. And we need to have them create money and extend credit for productive investment predominantly. So that summing up, we need money for human flourishing, not for speculation. Where new money goes, things grow because resources go there. The privilege of creating money has been picked up by the banks over the centuries without anyone noticing it. But money is, of course, based on the people's power, faith, and credit, so it must serve the people's interests. Money problems are not just individual, they're systemic, and we need to reclaim the monetary system so that we can direct our resources properly towards sustainable products and services that create eudaimonia for everyone, and not towards speculative bubbles that create hedonia for the wealthy. Here are some other alternatives that you can read about, and here is the literature that I covered.